Okay, the big cue for us this morning is the terrific numbers that came in on the GDP front. India's GDP grew by 7.6% in the second quarter. This is higher than CNBC-TV18's poll forecast of 7.03% and way more than Reserve Bank's forecast of 6.5%. Latha's here to tell us what went so right this time around in the GDP numbers. Latha, morning.
Well, it's not just that it is an upside surprise. It is the extent of the upside surprise. We haven't had 7.6% in a very long time in a normal quarter. I mean, we have it year on year. For instance, we had 13% and 20% when we were over a negative year. But for a normal quarter to generate this kind of growth is perhaps takes you back to the 2004 to 2008 period. And the second biggest thing, which of course everyone's been pointing out, is that this is manufacturing-led. Agriculture has been a no-show. It's just 1.2, and I think that was expected because of late rains, early rains, badly distributed. But let me just pause a little bit on the fact that services did not contribute. We've always been a services-led economy, but that's been a bit under the weather. I'll come to that in just a bit. You know, trade, hotels, a very big sector which generates jobs. Trade, hotels, transport and communication has done only 4.3%, and we may have to worry about that. But what we must definitely celebrate is this huge growth in manufacturing or industry and every aspect of it. You know, manufacturing is 13.9. I'm very sure I have not seen this number except, you know, going back to 2004 to 2008 period. Likewise, construction, 13.3. I mean, that's big. Power and utilities, that is electricity, 10.1, mining, 10. So anything connected with industry is in double digits, and manufacturing at 14% is really huge. Now, the pluses obviously is that the economy needs to be treated as a faster growing economy, and you have seen across the board upgrades. The biggest one comes from State Bank. State Bank was already full year at 6.7. They've upped it to 7%, and Cornwall there at 7%, City at 6.7. So we are now a 7% economy. That's very big. You know, there are not that many in the world. But the fact that it is standing on manufacturing is what is important. So today and for the days to come, please take note of all the capex stocks, you know, the L&T varieties, the cement varieties, construction stocks. You know, all those are the ones that the bulls may favor. Now for the brief minuses, consumption. 3.1% is a bit of a worry. You know, ultimately production grows only when consumption also gives you that boost. Government can give you that boost, which is what it has done. Capex was very strong. Government private final consumption expenditure went up by 12%. So that was very strong. But, you know, a 7% economy cannot be supported by a 9% fiscal deficit. We have a 5.9 in the center and 3% in the states. That is definitely a recipe for for troubled times, which means this growth has come on a bit of steroids of fiscal deficit, which has to be weaned away. So we can't expect replication. The other thing we should be very careful about, do you remember how the corporate EBITDA performed this quarter? Almost everyone had not a strong revenue growth, but a 30% EBITDA growth. So, you know, that is because a year ago, because of the Ukraine war, all raw materials were expensive. Now they've all become cheaper, and that explained the improvement in EBITDA and the improvement in margins. That also can't be replicated quarter after quarter. Already you can see that in the CRB index. So, you know, we must sober our expectations and not expect 7% plus, but definitely we have to up our expectations about the Indian economy and the Indian corporate sector. This is a new growth pace, no taking away from it.
Okay, all right, Latha, thanks very much for explaining that to us. So big numbers there, particularly on the capex and the manufacturing side of it, and we'll watch out for those stocks.